The most requested stock on the channel by a mile has been Capri Holdings. It's down pretty close to 49% as of Friday, and I'm putting up this video on Monday. It's been absolutely insane. There was to be an $8.5 billion merger between Capri and Tapestry. It got blocked, and the stock fell 45% the same day the judge blocked it. And it did surprise a lot of people because there's no way you could look at Tapestry's brands and then you look at Michael Kors and other brands that Capri own, and you could say those two companies combined could price gouge customers on some brands, or it could, harm people in some way, or it could do anything. So most people were really expecting the merger to go through because there's no way you could look at it and say this will cause, some kind of a monopoly, or it could cause something crazy when you have companies like LVMH and other companies exist even outside the United States. But there's so many better companies, and there's no way those two would cause, some kind of concerns. So a lot of people were expecting it to go through. It didn't go through. But you still have Lena Khan as the, FTC chairman, and she hasn't been too friendly to a lot of mergers, to a lot of companies. Something like 45% of the S&P is under antitrust or monopolistic investigation, Google and Visa and so many different companies. It's been crazy, and this is what it is. And even Amazon couldn't even acquire iRobot. I mean, it's been crazy, and you cannot really link the two. How Amazon could like monopolize iRobot or something crazy, but it couldn't even go through. So I wasn't really surprised, but it did surprise a lot of people. And the stock is down 49%. I'm gonna do my best to analyze it, although it's very hard. But I'm gonna do my best, and I'm gonna tell you if I believe Capri Holdings right now is presenting an amazing buying opportunity, or is it maybe still overvalued and it could be going much lower. If it goes down 50%, sometimes it doesn't mean it's 50% cheaper. Sometimes it could mean it's 50% less expensive. It's very possible. And Capri owns three main brands. This is their legacy brands. The first one is Michael Kors. This is the most popular one. This is their highest revenue one. Then they have Jimmy Choo, and then they have Versace, which a lot of people know, and they're well-known brands. I mean, a lot of people know that stuff. But the company has been a disaster. It has been struggling a lot. In terms of the first quarter of fiscal 2025, revenues decreased 13.2%, adjusted operating margin decreased 1.5%, adjusted earnings per share of only 4 cents per share. And I know whenever you're looking at Capri, you could look at other luxury brands or other brands like LVMH, and although it's hard to compare them, but other kind of luxury brands. And you could say maybe this is because of China, or it's because, of the luxury market in general is struggling. But I personally believe Capri has a much deeper problem than just China or just the market being soft for luxury goods. And if you look at the total Asia revenue, and you could look at it over here, this is as of 2022, it was 955, 2023 was 857, 2024 was 857. So over the last 2 years, in terms of the Asia revenue, it has been fairly holding up. So it's not much about China being weak. In my opinion, it's more about the legacy brands themselves being damaged, the legacy brands themselves being weak. And this is very hard to reverse. And I'm not talking about Versace. If you look at the total revenue of Versace, it has fluctuated over the last 3 years, but it has held up somewhat well. You look at Jimmy Choo total revenue, went from 613, 633, and 618. So it's been fluctuating, but nothing too crazy. But if you look at Michael Kors, this is where the problem is. And Michael Kors went from 3.9 billion to around 3.8 billion. Now it's around 3.5 billion. And this is a massive decline over the last 3 years, not just in Asia. In Asia, it actually held up better, but United States has been rapidly plummeting. In Europe and Middle East, it's been rapidly plummeting. And I believe the management of Michael Kors have been making some mistakes, hasn't been managed well. And the brand is losing its share, is losing its favorability amongst people. They're closing stores. And I think it's much more than just the market being soft or a China problem. It's more about the brand itself being damaged. That's what I believe in. That's what I'm seeing from the numbers. They're having to give up some discounts. Gross margins are starting to pull back. And it's very obvious that it is a problem within the company, that it's not just about demand or about China or about the market in general. It's also about Michael Kors' brand, which is very hard to reverse unless they cut prices and change marketing or do something. But it's very, very hard to reverse such trends. You could look at in terms of the income statement, it hasn't been the best. And the problem is that operating expenses did decline with revenues, but they didn't decline as much as they should have, which led the company to put up an operating loss instead of having an operating profit. So they also have to get things a little bit better under control. Inventories are starting to increase. They did increase quarter on quarter, although they're down year on year, which is an improvement, down year on year. But quarter on quarter, they've been increasing from 862 to 902. And I hope this trend reverses. But from me looking at all those things, I'm seeing some bad management. I'm seeing a brand, the legacy brand, which where most of the revenue comes from, Michael Kors, likely has some challenges itself. The brand is being damaged, and consumers aren't buying it as much as they did before. And you can clearly see it from the massive decline in revenues from 2022 to 2023 and now into 2024. And the company does not have the best balance sheet ever. They have 213 million in cash and cash equivalent. Short-term debt is 461 million, double the cash, and long-term debt is 1.2 billion dollars. So they also have a lot of debt. And if you're looking at this company, at everything I showed you, the brand itself is damaged, they're declining in revenues, they have a lot of debt, and they have all these things. Why would you even consider buying Capri? And this is where it comes in terms of the difference between value investing and growth investing or quality. If you're a quality investor or if you're a growth investor, you would never look at something like Capri. You would say the company is horrible for the long term, 10 years from now, it's not going to exist, and it's a bad company in general. This is what a quality investor or a growth investor would believe. But if you're a value investor, you would look at it as, okay, this is what I'm getting in terms of the fundamentals. How much am I paying for the fundamentals? Because sometimes it's not just what you buy, it's what you pay that determines if you're going to make money on this investment or not. And this is something that a lot of people struggle to understand, is they believe if a company is declining in revenue or if the company has a lot of debt, that means it's not a good investment. This is not true. It could be an amazing investment, and I bought many of them and made a lot of money with them because I bought them at a dirt cheap price. It was overextended to the downside. I bought it cheap enough. The market realized the mistake. The company got a multiple expansions. They paid down some debt. They got a credit rating upgrade. They refinanced. A lot of stuff happened. The stock goes up 50, 100%. And this is something that Howard Marks said it himself. And I always like to quote him. It's an amazing quote. And he said, it's not what you buy, it's what you pay. And success in investing doesn't come from buying good things, but from buying things well. And if you don't know the difference, you're in the wrong business. And if we look at something like Capri, what is it trading at? What kind of multiple is it trading at for such bad fundamentals? And Capri is trading at 8.5 times earnings, 8.5 times PE ratio, or around a 13.5% free cash flow yield. And this is, in my opinion, very cheap for the company. Even if it stays flat in terms of revenues, even if it declines a little bit, 1 or 2%, as long as it's nothing crazy, 13.5% is on the overvalued side, is on the undervalued side, or overextended, you could say, overreaction. In terms of a free cash flow yield, the mean was around 10% free cash flow yield. It traded as low as 5% in the good times, and now it's trading at 13.5% free cash flow yield. And this free cash flow has likely bottomed in 2024 and is expected to expand into 2025. Over 15 analysts, you could see it on ticker, 15 analysts, they're expecting 336 million in 2025, and not much growth over the next 2 years, like 1 or 2% in terms of revenue growth, and a slight free cash flow margin expansion. So they expect 2024 to be the worst year for Capri, and 2025 and beyond to look much, much better. And if the analysts are somewhat right on 336, then Capri would be trading at a 13.5% free cash flow yield, and then would have enough free cash flow combined with their 220 million cash position to take care of the short-term liability, which is around 461, then they would still have the 1.2 billion, which is not due anytime soon, it's due in the long term. They could likely refinance it or slowly pay down the debt from the free cash flow. So the way I would look at Capri is not a good company. It's not a quality investment at all. They don't have the strongest brands, they don't have the best brands. But in my opinion, it could make a good turnaround. And if it's trading at 13.5%, and assuming this was it in terms of Capri, this was the bottom, and maybe it's not going to grow from here, but it's going to somewhat stay flat. 13.5% free cash flow yield is cheap. Normally, such companies with no growth, they trade around 8 to 10% free cash flow yield, and Capri is trading at 13.5. So I wouldn't be surprised if you're buying Capri over here to expect 13.5, 14% annual return on Capri, excluding a multiple expansion. And if they do turn around Michael Kors, or maybe they get acquired if we have a new FTC chairman, and then maybe companies like LVMH would like to try it out, maybe other companies would like to come in. Maybe you could have an entirely change in sentiment in terms of mergers and acquisitions if you have another FTC chairman next year, and maybe another company would, or even Tapestry itself would like to fight it and try to acquire Capri again. And I believe the company will ultimately be acquired. But if it wasn't acquired, you're getting around 13, 14%, in my opinion, annual return in terms of value creation or shareholder yield on Capri. And plus, you could have some kind of a multiple expansion from 13.5 free cash flow yield back to 10 or 9% free cash flow yield if they do turn around Michael Kors, or if it stabilizes, and if they start paying down the debt and reduce interest expense, which is going to increase free cash flow over the long term. So from me looking at Capri over here, I would say the stock is definitely undervalued. I would say the stock could make a good turnaround investment, and there's a lot of bad sentiment around it. But for me personally, I'm not buying Capri because I haven't been doing a lot of turnarounds recently. I've been focused more into longer term stuff. And I believe Capri is a horrible long term investment. I'm just being honest. If you want to bet on Capri, it's mostly a short term turnaround. Once they turn the company around, the multiple adjust, or if it gets acquired, then there's not much growth left, and it would be priced to perfection within 1 to 2 years. And I wouldn't be holding it longer than that because it's not the best long-term investment to own. And this is just my opinion on Capri. Maybe it wasn't the best analysis ever, but I hope you got some value out of it. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.